Hello everyone, it's Stephen Whiteside here from theuptrend.com with this weekend's edition of Protect Your Portfolio. In this presentation, we're going to go through 9 topics and I'll try to get through them as quickly as possible. Let's start off this weekend's presentation with the major headline of the week, and that of course is the fact there's no major trend changes this week. If you're a long-term investor sitting in cash, or if you have bear ETFs, there's no reason to take action this week. Of course, if you're a short-term trader and you were watching the market during the week, there was a lot of volatility and there was certainly a lot of new sell signals based off Thursday's trading action. Now, starting off looking at the TSX, we traded up into the channel on the previous week, and this week we came down and closed once again below the lower channel line and below last week's close. Similar situation for the NASDAQ 100. Now, last week at this time, we were looking at a market that had basically paused. The market had come off a 3-day long weekend, and so we had a 4-day holiday shortened work week. And during that time, you can see the bar had the price range of the S&P 500 had contracted. The bar was very small compared to the previous bars. And so anytime that you see volatility contract that much, at some point it's going to expand. Now this week, volatility even decreased even more, in which up until Thursday's open, we were having an inside week for the S&P 500. And then what do you know, on Thursday, volatility started to expand, and it expanded to the downside both on Thursday and Friday. So there we are. We haven't taken out the recent lows, but we're getting pretty close to testing those. So we're going to have to keep an eye on those, and we'll check those numbers out later in the presentation. Now, the drumbeats of recession continued to beat louder this week. We see that U.S. consumer sentiment fell in June to its lowest level ever. Of course, that has a lot to do with inflation, which is raising prices across the board. It also has a lot to do with political unrest in the U.S., and that's something that the Fed can't deal with. Now, inflation rose 8.6% in May, the highest since 1981, and of course, that's what the Fed wants to fight. And most of that inflation is coming directly from higher energy prices, which of course gets spread out through the whole economy. And nothing changed there. We saw crude oil continue to move up another 2% and change. So everybody's expecting a rate hike, but with the numbers that came out this week, some people are expecting a faster rate hike. In fact, we might even see an emergency rate hike over the weekend. That's probably not going to be good for the stock market going forward. So expect bond yields to continue to move up. Bonds themselves continue to move lower. Now, I saw some people come out on TV this week and they were asked the question, well, if the stock market's going to continue to fall, where should I put my money? And some people talked about putting their money in bonds. And right now, that's not a good thing. Bonds are still moving in the same direction as stocks at the moment. And of course, we'll check the charts, and as soon as we see bonds starting to move up, and once they generate buy signals, we'll tell you, and you can put your money in bonds at that point. Now, this week we saw a confirmed lower high, and now, of course, the big question is, do we put in a lower low, or will the May lows hold and act as support? Well, we'll take a look at those numbers in a few minutes. Of course, what's the opposite of support? It's resistance, and all the major resistance that we've been talking about over the past month held the market in check. So for the S&P 500 Spider ETF, we were looking last week at the May lows holding us in check, and that continued through this week. And what do you know? We came down to our first price target line and closed there on Friday. Looking at the Qs, I told you the number to watch was 312.50, and we couldn't take that out. One day we traded slightly above it. That was it. And then we came down, and now we're heading lower, looking to see if the May lows will hold. Looking at the iShares for the Russell 2000, it was 187.50. Notice we were able to poke our head above resistance, but we weren't able to get up and over resistance. So still stuck at resistance. And all these numbers are going to come back into play when the market's ready to move back up, which probably will not be this week. Looking at the iShares for the microcap sector is 118.75. Looking at the SOX index, it was 31.25. That held us in check, and now we're looking to see if support holds at 28.12.50. Looking at the Canadian market, it was 32.03 on the iShares for the TSX 60 and 28.13 for the BMO TSX Composite Index ETF. Next up, let's take a look at the price of gold. Last week at this time, we were looking at gold stuck in a range between 1875 and 1812.50, and we were looking for a breakout of that range. We'll move ahead 1 week, and on Friday we closed at 1875 and 20 cents. That is not a breakout. We're still stuck to 1875, trying to see if we can get up and over it. We had a wild day in the gold market on Friday. I thought we were going to head all the way down to 1812.50 on Friday before we started to reverse. Now our next target to the upside, if we can start breaking out above 1875, is 1937.50. Now it's always a good idea to look back in time and see if that price target number had any significance at all. And you can see that in the month of March and into early April, that was a major area of support. Then we ran up to the next price target line and then started to come down. And of course, once that area of support broke, we moved down 2 lines. So 1937.50 is our next target if gold can keep going. Now, gold itself was on a buy signal going into Friday's trading action, but look at how wide the bar is compared to Thursday's trading action. So a lot of people were spooked in the gold market on Friday. We did close above the 200-day moving average, but not the 100 and the 50-day moving average. We're stuck there right now. For the GLD, if you're watching the GLD, it's 175, trying to break out above that. Then 178.13 and 181.25 are the next targets. Looking at gold stocks, they had a wild day on Friday as well. You can see how low we got on Friday before reversing on the GDX and closing up at the upper channel line. Looking for a close on Monday above 32.74 for the GDX. And looking at the iShares for the TSX Global Gold Index, we are back on a buy signal as of Friday's close. So just be careful. We're looking for gold to continue to break out above 1875. So far, it has had a lot of trouble doing it. So hopefully it'll be able to do it on Monday. Next up, a quick look at cryptocurrencies, and no trend changes for Bitcoin or Ethereum. Looking at the weekly charts here, this is just a public service announcement, but please do not try to spend any time explaining to me why I should own cryptocurrencies. They're obviously not a hedge against inflation. They're not a hedge against a falling stock market. They're not a hedge against political uncertainty, political unrest. I really don't know what the use is of them. I think people are having fun with them that have too much money. But otherwise, I'm looking at this chart, and you can see that we're starting to break down below the lows from last year for Bitcoin, and that's certainly true for Ethereum. So if you want an asset that's losing money, sure, buy cryptocurrencies. I really don't want to have anything to do with them. I'll chart them, and if they're back in an uptrend at some point, sure, you can buy them, but I certainly wouldn't be a buyer and a holder of any cryptocurrency. Okay, we're getting right to the end of the presentation, and there we've got the market looking over the edge. What does the edge look like? Well, for the iShares for the TSX 60, the May low was 30.07. For the S&P 500 Spider ETF, we're looking at 380.54. For the Qs for the NASDAQ, we're looking at 280.21. Those are the numbers we need to hold. Otherwise, this market is going to continue to move lower. There's certainly a mathematical possibility that we make a double bottom here, but I think with everything that's going on and with the Fed being pushed in to move faster and harder, I believe the lows are going to break. And of course, we've got downside targets for all the symbols in our database. And last up today, the VIX. Of course, we're going to remain bearish on the stock market as long as the fear index continues to close above 2432. That's the magic number this week. We actually traded below that level during the week and then came up hard. And we're still on a buy signal here. And of course, a buy signal on this chart tells us that the market is not happy, and we're looking for lower prices. Okay, folks, enjoy the rest of your weekend. Next time you'll hear my voice is on Tuesday morning.